Welcome to Everything Money. Today we talk about Zillow. This stock had a crazy last couple of days. We'll talk about it. We will show you the financials behind this company using our software. We will separate the financials from this ticker price. This thing got smoked, and we will tell you all about it right now. If you're interested in trading this, Trader Mo will show you what you could have done on this rise and fall of Zillow. We'll talk about Cathie Wood all in this video. But first, who are we? I represent you. I will bring your questions to a couple wealthy guys that manage a ton of real estate, a few businesses. Paul, I got 2 or 3 businesses, you know that. And sorry, that was a YouTube quote. I love you. And all this and more. Stay tuned. We will get to what you should be paying for Zillow. It might get ugly because this is a very disruptive company, and we'll tell you why it isn't. I give you Paul Gabriel. Go ahead, Paul.
Hola.
Oh, muy bien. Hola.
Guys, follow us on Instagram before you do anything. We have a new Everything Money account, and then follow us personally. That way we don't feel left out. So Zillow, Mo's been following Zillow a lot more than me. Mo follows the news a lot more than me because every morning he does the news show and he talks about it. I'm more of the, I try to be more of the value investor when people are like, Paul, did you see the stock today? I'm like, no, what happened? But Paul, you own the stock. I'm like, yeah, I really don't know.
Right.
So Mo, why don't you tell us what happened with Zillow? Because this announcement of the houses was announced like a month ago, right?
Yeah, Mo, you're worried.
Last week, I think.
Oh, I thought it was before then, wasn't it?
No, I think it was last week. So basically, 49% of their revenue comes from them flipping houses. And it turns out that they've bit off more than they can chew. Their goal was to be buying 5,000 houses per month to flip by 2024. So they took a big write-down. I think it was $304 million write-down, and they reported it yesterday on earnings.
That's not even that big of a write-down.
It's not, but I think they're in financial they're gonna have a lot of trouble coming out of this.
Well, we'll look at the financial because I don't know if I do believe that Zillow has a lot of value to like.
I compare them to the other in the industry, Redfin, Realtor. I think those are better in my opinion as a user.
But do they give values?
They all do.
Okay.
Yeah.
All right, so guys, what we're gonna do is we're gonna use our Everything Money software, which is back here. So let's go to the 8 pillars tab. Let's type in Zillow.
We use our 8 pillars to screen stocks. We take a look at the financials very quickly. Don't read a 10K. Don't listen to conference calls. Just real quick, within 10 seconds, figure out, do they make money? And is this something we want to invest in? And we'll show you right now.
All right, so look at this chart first off. Let's see this run up since the COVID crash. I mean, the COVID crash, it was what, $25, and now it's over 200. Well, it was over 200, and now it's down to $65.
Yeah.
And this is crazy. Okay, guys. So first off, this is a $16.7 billion company. Guys, before we go further, one of the things I always recommend doing when you're looking at a stock, look at the market cap and then go find other companies around that market cap. So go find what you can buy for $15 to $20 billion compared to Zillow, because here's why. They have $5 billion in revenue and they lost money last year. Okay, so our first pillar is we want the 5-year PE to be under 22.5. Well, the hard part is when they have no earnings, there is no PE. That's what we have here. There's no earnings. Okay, fine. Return on invested capital. We want the 5-year return on invested capital to be greater than 9%. This is greater than negative 9%. So
Hey-o.
This is also an X. There's no dividends. Guys, on our software, I put some of the biggest metrics on the main page. 5-year average free cash flow is in negative 670, and last year's free cash flow is in negative $3.4 billion.
Now, this is typical for a young company, Paul?
Yeah, but
growing
how
company?
long has the company been around?
How young
look
are
at this
they?
ticker from 2012.
This is not young anymore.
It went public. I mean, I'm looking at 2011.
Okay.
I'm looking at going, okay.
So how do they have such a great year and such a bad year financially?
So I don't know. And we're going to go look at, so guys, pillar number 3 is we want to see revenue growth.
Keep going.
Last 5 years. $1 billion to $5 billion, check mark. So guys, if you're looking at the stock, you're like, oh my God, this is a no-brainer. Revenue's up 5 times in the last 5 years. It's up 50 times in the last 10 years. But guys, if they're not making money, what the heck are you doing here? So pillar number 4.
Profit growth.
Let's look at that. They lost 40 million to lost 220. That's an X. They've lost more money. Oh, wow, look at this. They actually made money 10 years ago.
You make that in a week, Paul. But tell me this. Why?
In a bad week.
The dummy that I am is they have like record revenue, but they also record losses. And so they're choosing to lose money or what?
Well, a lot of companies, guys, so you got to remember that a lot of companies in early stages Zillow's still trying to grow and grow and grow. They're going to lose money along the way. I mean, we do that in some of our businesses. When we first started business, the first year or two, look at this channel.
Yeah.
This channel was losses for 2 years before we finally started making money. That's okay, but
Well, I mean, to think that you were paying me $700,000 a year.
I know.
To host the show, it's astonishing. Go ahead, Mo.
At some point, were they
Agent.
making money? Like
Profit-wise?
Yeah.
Just 1 year, back in
that's it.
2011.
Oh, okay. I was thinking maybe they started making money, and then they were like, okay, now we're going to try to do this.
They made 6.3, lost 14, lost 30, lost their 135,
Yeah.
lost 222, lost 40, lost 100.
I was thinking this whole home flipping thing was kind of like they made it in the one area, and they were like, okay, let's take over the housing market.
Well, so that's
that was
my
the
question to
CEO's
you, Mo.
quote.
How much of this revenue is from home flipping? Because guys, if you flip a home for 200 grand, you do 1,000 of them. It's a lot of money.
That's
I
like
heard it was
200,000 grand.
200,000 grand. Yeah.
So
Okay, keep going.
first off, pillar number 5. I want to go to pillar number 5 because Seth, what are you going to guess it's going to be? I have not looked. Pillar number 5 is shares outstanding. We
If
want shares
Cathie,
staying the
I'm
same.
sorry, I didn't mean to. Go ahead with shares
We want
outstanding.
shares to be staying the same or going down.
If
but this
Cathie
makes-
Wood loves this, I would think they're selling off shares at
Well,
a
plus
much
they're
quicker
losing
rate
money
That
like
is an
crazy.
amazing thesis.
than they're selling off those houses, Mo. Go ahead.
And the other thing is, they're losing money like crazy. It's got to come from when a company loses money, you got to replace it with debt or equity. And equity is given in form of shares. I'm very confident the shares outstanding is increasing in this company. So we scroll down, we go to our software, go to the income statement, go all the way down. Hoo-ha, boy. 188 to 250. That's an X. Guys, they've increased their shares outstanding by almost 50%, which means you are being diluted. Look at this. It's almost tripled from 10 years ago.
Yeah, I was going to say, look at that
Triple.
2012 number.
So guys, what this means is if you had shares back in 2012, if the business tripled in value, you basically did not make any gains because now they're splitting up the shares by 3 times the amount. Right? So let's look at this math. This is very important. I want everybody to
Paul,
understand.
I like when you draw the pie. Give a visual.
Okay, so let's do this first. Let's say a company makes $1 per year and there's 1 share outstanding. Then it makes $3 per year. But they've tripled their shares to $3 outstanding. It's still $1 per share and $1 per share.
So they tripled their profits, but you get nothing.
Yes, so basically you've got the same amount of profit by tripling the share, even though the company tripled. Same thing's happening here. Now, somebody might be smart out there and saying, well, they're losing lots of money, so now the losses are being shared. Good point.
Touche.
Touche.
Drop the mic on me and just leave the room. I don't get it. So, guys, all around, guess what? I'd rather have them issuing shares than when they're losing money than issuing debt. But either way, so
Pillar number 6 involves that debt, Paul. It's total long-term liabilities divided by free cash flow.
Yeah, the hard part is what we usually do here is we go to the 5-year average free cash flow.
Which is nothing.
Which it's negative, and we multiply by 5. We want the number to be under that, but when it's a negative number, you can't really have negative debt.
So how bad are they in debt?
Let's go look.
Is this a balance sheet or this is not?
We're gonna go to the balance sheet.
Okay.
We're gonna scroll all the way to the bottom. It's not terrible. $2 billion in long-term liabilities. So for our metric, we want their average 5-year free cash flow to be $2 billion divided by 5, or $400 million. Keep in mind, last year they lost $3.3 billion in free cash flow.
A little off then.
All right.
Pillar
Hey, Mo,
number
can you do me a favor? Can you look up what percentage of their revenue is from the house flipping?
So obviously, pillar number 7 and 8 won't get us to a desired market cap. We'd like to pay for this.
So guys, free cash flow is the metric I really care about because earnings can be manipulated with SEC rules and accounting rules, but free cash flow is harder. And free cash flow is cash from operations less your capital expenditures. By the way, so now I used to say there was 4 things, now there's 5 things. My cousin texted me yesterday and said, "Hey, what is this 5th thing?" He's like, "My head just exploded." I laughed.
Our editors got on board quickly. They put your 5 right in there,
Oh,
baby.
good.
Now. Yeah,
So guys, free cash flow can be used to do 5 things. Pay dividends, buy back shares, pay down debt, make acquisitions, and reinvest back in the business. That was he's like funny kid. He lives in Canada. He's just like, Paul, what happened here? Like this blew my mind. But when you have negative free cash flow, and by the way, if the capital expenditures are just insane, that's one thing. But if you look here, oh man, boy, look at this all over the board. Changes in working capital is the big thing. The bottom line is, guys, I added this line to our software that nobody else has in their cash flow statement that makes it easy for you. And I'll show you how the software does really well for all the people who are looking at the math going, I don't want to do that math. I don't blame you. I like doing the math, but nobody else does. So their free cash flow 5 years ago, they actually had free cash flow 5 years ago, 136 million to 3.38 billion. That's an X. And there's no value. We usually what we do is we take the 5-year average free cash flow and multiply by 20 to come up with a value of the company we want to look at. But if it's negative, there's no value. So guys, all around, I was going to show you guys. Here's our software. Here's the 8 pillars tab.
This is a train wreck.
It does all the math for you. Now keep in mind, I have bought a company that had all 8 X's. That was Carnival Cruise Line. I own Carnival Cruise Line. It had all 8 X's. But what we did here was we created the software because early on in this channel, our subscribers were watching videos and saying, hey, how do I do this research without waiting for you to make a video on the stocks I want? So we created the software. We spent hundreds of thousands to create the software. You get everything here that we did. It comes on your phone, which is awesome. It's all mobile friendly. You get daily exclusive content from us. That's 2 or 3 videos a day from us talking about other things only for our subscribers. You get access to Mo, Seth, and I. You get everything that's coming on the software still, which is everything here on the right side.
Real estate calculator, momentum trading.
All this stuff. You get the retirement calculator, all these things going. You get all of this. And most importantly, you get access to our 6,000 other members because most people join our software because they're like, hey, I don't have anybody to talk to about investing, but you guys make sense. You have a community to talk to about all your investing ideas. This is only 90 cents per day. Less than a cup of coffee. It's 90 cents per day. It allows you access to all of this. If you are serious about your financial future, 90 cents a day, either making you 1 or 2% a year extra or saving you 1 or 2% a year in losses, which will happen, could make you hundreds of thousands, if not millions, in your lifetime. 90 cents a day. This is a no-brainer. Go to everythingmoney.com or Patreon. Either one works. The benefit of everythingmoney.com, you only get charged once for the first month, and you don't pay sales tax yet because we're not big enough. So that's the benefit of everythingmoney.com. But either one gets you access within minutes. No brainer. Now we're going to go. We can't even do the stock analyzer.
No, it's not impossible. We can show you on a stock you might want to invest in.
So guys, let's look at a stock just randomly to show the stock analyzer tool. Let's go to Microsoft.
While Paul pulls that up, Mo, we were saying that Cathie Wood bought more of Zillow.
Jeez, I know.
Prior to this dump. Prior to the stock falling 25%, and then she sold. So
she sold it yesterday.
This is the buy high, sell low mentality. This is good stuff.
She bought a ton on Tuesday by the disruption dip, and then sold it all because it wasn't disrupted enough.
So tell me in the comments what I'm missing. Why she would be buying and selling? Obviously, she's notifying her holders every day, like a video game. But it's interesting, Paul.
It really is. I don't get it.
You can't stand much of her, can you?
Well, I don't like contradictions. I don't mind somebody being wrong. I'm going to be wrong a lot.
Of course.
Warren Buffett's been wrong. Everybody's going to be wrong. The best investors ever, if they're right 50% of the time, will go down in history. What I don't like is hypocrisy and contradiction. She sits there and says value investing is dead and then says, oh, if Tesla grows 92% a year, it's a value stock. Well, if value investing is dead, why are you trying to be a value stock? She goes out and buys, 238,000 shares of a company, and if she's a good investor, if they really do fall 20% and the fundamentals haven't changed,
why is she selling?
Why are you selling your entire? I mean,
that makes no sense. You should be happy.
If Intel fell 20% tomorrow, what would I do?
Yeah,
buy.
Right.
I would buy a ton, unless there was some damning news. And she might sit there and say, "Well, the news changed." Like, really? The news changed?
It didn't really change. Nothing changed. We already knew this. We knew all of this last week.
Yes.
And then also her stance on Tesla. It's going to be a $3,000 stock by some point, and she's selling it in the 700-800s. Like, what are you doing?
It doesn't add up to me.
No,
so
it doesn't add up.
That's
it's
the
just
thing I
very
don't
confusing.
like.
That's the thing.
Show us this tool we could use to find a company we might want to invest in.
Guys, when you're looking at a stock, the most important part is, what do I pay for the stock, right? Is it worth it? So we created the stock analyzer tool. What this does is it takes all your assumptions, you pick a time in the future, up to 20 years. So for Microsoft, 10 years, you pick the number of assumptions you want to make. I pick 2. And then you just enter your assumptions here. And what it'll do, it's going to spit out an exact value for what the stock is worth to you today. So let's do. So I'm just putting in these numbers right now to make things easy. 15, 18. You input all these numbers, and the video right here will show you how to do everything. You hit the analyze button, and it tells you Microsoft's too expensive because the stock is at 332. And you should be paying between 160 and 270 for the stock.
When you break this down, Paul, it's like any investment is the present value, I have to say it real slow, is the present value of all future cash flows. And so at some point we have to assume and make a guess as to what those future cash flows could be, and then go backwards in time to today. That's what this stock is helping.
Correct. And this is why I don't like a company like Zillow. I avoid companies that lose money hand over fist, because you have to be able to say, what are they going to make in the future? Well, it's already hard to determine the future on a company like Microsoft because we don't know the future, especially 10 years ago. 10 years ago, I was buying Microsoft and I was literally made fun of by people saying, you don't understand what a dead company is. And since then, the revenue's over doubled. So you don't know what's going to happen in the future, but it's especially hard to know what's going to happen in the future when the company loses money over and over. You have to make assumptions on profit margin. What's the profit margin going to be? Well, we don't know. They've never made money. 10 years ago, they made 6% on their revenue. I don't have a clue. So that's why this is the way that works for me. Now, Mo, what he does is he does charts. Doesn't care what the fundamentals are. Doesn't care anything about that. But that's why we're everything money, because there's multiple ways to skin a cat. There's multiple ways to make money in investing. Momentum, charts, and value. We like those three.
Mo, did anyone in the Bid&Ask Nation catch this fall yesterday, day trading it?
Mm-hmm. So I'm just going to show you here for a visual. You can see how much this thing fell just in 2 short days based on their earnings report. So what I would do, and what a lot of people did, is they just jump over here. This is a 15-minute chart. So what a 15-minute chart is, it's basically taking one candle that I just showed you on the previous screen and opening it up. And you're seeing every 15 minutes you're getting a candle. Yesterday was perfect. The couple things that you look for your trend being under 20%, between 20% and 0. So that is your sweet spot when you're shorting on a 15-minute chart. The next thing you're looking for is volume. Make sure it's consistent. You had very consistent volume throughout the entire day with a little bit of a dip right there. Then you're looking for an adding point. You're going short on an engulfing candlestick, and you run it as long as you are below 20% down here, you're good. We popped over 20% at about 3:15 in the afternoon. You could have shorted that entire thing down confidently and made a ton of money on the way. Very, very, very simple.
And systematic. It's a process.
And systematic. Guys. And this is you wonder, when do you take profits? When do I exit my position and buy back my shares? Right there. As soon as you pop over 20%, you're good.
So if I'm a normal chap with a day job, how would I figure out this is happening in real time?
So day trading is tough for people with day jobs because you have to be sitting at your computer. Because any time between 11 a.m. yesterday and 3:15, that thing could have popped over and you would have had to exit. And if you're in a meeting, it's hard for you to do. So day trading is much more of the person that has a computer, that they can sit at the computer all day and be alert. Even if you're working, you can kind of be paying attention to it. But if you want to learn how to do this, there's multiple day trading seminars in the Bid&Ask Nation that you get access to. You get access to me. You get access to all of my teaching platforms with the Bid&Ask.
Paul, final take.
I'm avoiding Zillow.
Right?
Yep, very straight up. Watch our other videos. You'll see me say opposites of other stocks, but I'm avoiding Zillow.
That's our take. Fondle thumbs up. Join the community below, and we welcome you in. We're giving away a Tesla in a mere 4,000 subscribers. Incredible. And we will not be buying Zillow. So this is not financial advice, but don't buy Zillow is our advice. So see you next video.